Welcome to the channel, I'm Stella. If you have checked your portfolio lately, you might have noticed that the US stock market took a serious hit. So what happened? Well, a new sweeping US tariff policy is shaking investors' confidence across the globe. Today we are diving into what is going on and why the market is reacting this way. And most importantly, what you should do with your portfolio. Let's dive in. The market dropped sharply after the U.S. announced a new round of global tariffs aimed at foreign imports, particularly in the tech and manufacturing sectors. Major indices like S&P 500, Nasdaq, and the Dow also red across the board. Apple, Tesla, Nvidia all hit hard. Why? Because tariffs make it more expensive for companies to import materials or sell goods overseas. That squeezes profit margins, raises production costs, and sends a ripple effect through global markets. As a result, businesses may have to either raise prices for consumers or absorb the extra costs, both of which can slow down economic activity. When one country imposes tariffs, it can lead to retaliation from others, further escalating the cost of doing business internationally. In some cases, entire industries might struggle to maintain profitability, leading to job cuts or even closures. For consumers, tariffs can mean higher prices on everyday goods, from electronics to food products, as companies raise their prices to account for the increased costs. On a larger scale, tariffs can slow global trade, disrupting supply chains and causing delays in the delivery of goods. For investors, this can lead to increased market volatility and uncertainty, making it harder to predict the performance of companies and sectors that rely heavily on international trade. Investor sentiment shifts fast, and Wall Street doesn't like uncertainty. Should you be worried? Look, market volatility isn't new. We have seen sharp drops before due to trade wars, interest rates, and geopolitical headlines. And guess what? The market has always recovered. So the real question isn't, will it bounce back? It is, how can I position myself smartly during the dip? Section 3. What to do with your portfolio. Let's talk strategy. Here are 6 smart moves to consider during this market drop. 1. Don't panic sell. Selling into a falling market locks your losses. If your investments were solid before the drop, they likely still are. 2. Rebalance if necessary. Use this time to check your asset allocation. If you're too heavy in volatile sectors like tech, you might want to shift toward more stable areas, like dividend-paying stocks, consumer staples, or bond ETFs. Look for buying opportunities. Some great companies are trading at a discount right now. If you got extra cash, think about the dollar cost averaging into high-quality stocks and ETFs. 4. Consider tax loss harvesting. If you do have losing positions that no longer fit your strategy, this could be the perfect time for tax loss harvesting. That means selling investments at a loss to offset gains elsewhere in your portfolio, potentially lowering your tax bill. Just watch out for wash sale rules. You can rebuy the same security within 30 days, or you lose the tax benefit. Next, hedge with international exposure. Tariffs hit U.S. exporters hard, but some foreign markets may be less impacted. Adding international ETFs or emerging market funds could reduce risk. 6. Stay informed and rational. Avoid knee-jerk reactions. Markets recover, and the smartest investors stay grounded during times like this. Historically, markets tend to rebound within months or even weeks after policy shocks once the dust settles. If you're investing for the long run, remember, time in the market beats time in the market. So yes, things look rough right now. But if you stay calm, stay diversified, and stay committed to your strategy, you come out stronger on the other side. If you found this video helpful, hit that like button and subscribe for more money tips. Thank you for watching. I'll see you in the next one.